Bitcoin just pushed past $90,000 again. In every corner of crypto Twitter, the laser eyes are back on. The mainstream media is running breathless headlines, and that feeling of pure euphoria is back in the air. Everywhere you look, the message seems clear. The dip is over, the bull run is back, and we're all heading for the moon. But I have to be honest with you, I'm not popping any champagne just yet. I'm here to offer a different perspective in a market that feels like it's getting a little too high on its own supply. Because while the crowd sees the start of another parabolic moonshot, I see what looks like a classic trap. I see something that looks an awful lot like a dead cat bounce, a sucker's rally, engineered to look like the real deal. But I believe it's fueled by something far more complex that most people are missing: a fragile and over leveraged market structure. In this video, I'm not just going to give you a gut feeling. I'm going to lay out a thesis and investigative analysis. We're going to peel back the layers of this market and question what's really happening under the hood. This isn't just about a price chart. It's about a battle for control, a battle between old school finance and the decentralized future that Bitcoin represents. And right now, I believe the old guard is setting a very clever trap. I'm going to lay out the evidence piece by piece and show you why this surge to $90,000 might not be a sign of strength, but a symptom of a deeply fragile system. We'll look at the on chain data the bulls might be overlooking, the macro pressures they're conveniently ignoring, and the historical patterns that are screaming a warning. My goal here isn't to spread fear, but to offer a clear headed analysis. I want to give you the framework to see this market for what it is so you can protect yourself and avoid getting caught on the wrong side of what could be a major market shift. So stick with me because my take on this might just change the way you're looking at this market. Before we dive into what I think is really going on, it's only fair to build the strongest case for the other side. To be credible, you have to understand the opposing argument. So let's put on the bull hats for a minute and see why everyone's so excited about $90,000 Bitcoin. If you've been on social media or watching the news, this will probably sound pretty familiar. The main engine of the bullish story is, without a doubt, the institutional floodgates that have been opened by the spot Bitcoin ETFs. The narrative is that these products, from giants like BlackRock and Fidelity, have created a permanent and unstoppable fire hose of demand. We're told that every day more institutional capital is pouring in, buying up every available Bitcoin and creating a massive supply shock. This story is powerful because it's simple. Big money comes in, supply is limited, so the price has to go up. It feels inevitable. This narrative is then supercharged by an army of analysts and influencers pointing to models that forecast staggering new highs. We're hearing targets of $112,000, $125,000, and even $150,000 by the end of this year or early next. These predictions are often wrapped in sophisticated sounding technical analysis. Bullish chart patterns, moving average crossovers, and Elliott wave counts that all point to the moon. On top of the ETF story, you have the corporate treasury angle. Companies like MicroStrategy are continuing their aggressive accumulation, framing Bitcoin as the ultimate shield against inflation and currency debasement. Every purchase they make is seen as another brick in the wall of institutional legitimacy, proof that Bitcoin is growing up from a retail plaything into a serious macroeconomic asset. And finally, you have the macro story, which, if you're a bull, looks incredibly positive. The argument here is that with global liquidity still high and central banks under pressure to cut interest rates to manage their massive debts, hard assets like Bitcoin are the only safe place to be. They argue that as fiat currencies are debased, capital will naturally flood into Bitcoin's finite supply, sending its price into the stratosphere. Some believe the Federal Reserve will have no choice but to turn the money printers back on, creating a tidal wave of liquidity that lifts all boats, especially Bitcoin. So, let's sum up the bull case. A tsunami of institutional money from ETFs creating a supply crisis, corporations adopting Bitcoin as a reserve asset, analysts calling for astronomical prices, and a macro environment that seems tailor made for a hard asset to soar. From this view, $90,000 isn't the top. It's just a quick stop on the way to six figures and beyond. It feels like an open and shut case. It feels like you'd be a fool to bet against it, and that is exactly what makes it so dangerous. This whole narrative, as compelling as it is the surface story. It's the story they want you to believe. It's like a beautiful, pristine layer of ice covering a deep, dark, and treacherous lake. Because while the bulls are glued to the demand side of the equation, the ETF inflows, the corporate buying, I believe they are completely missing the tectonic shifts happening on the supply side and within the very plumbing of the financial system. They're celebrating the financialization of Bitcoin without stopping to ask what that really means. So now let's take off the bull hats. Let's look past the surface and begin our investigation into what might really be happening. This is where we go from being passive market observers to active financial detectives. We're going to look for the clues that others might be missing. My investigation is broken down into three main exhibits. Each one builds on the last, painting a picture that's starkly different from the euphoric consensus. Exhibit A: the war for monetary control, Wall Street's Trojan horse. The first and most critical piece of evidence isn't on a price chart. It's in the strategy rooms of Wall Street, and specifically in the moves of institutions like JP Morgan. For years, the bank's CEO, Jamie Dimon, was Bitcoin's most famous and loudest critic. He famously called it a fraud and worse than tulip bulbs. This created a simple story: Wall Street versus Bitcoin, the old guard versus the new. But something has changed. And this change is, in my opinion, one of the most misunderstood events in the market. JP Morgan, the former arch nemesis, hasn't just warmed up to Bitcoin. Recent filings show it is now moving to financialize it. The bank has made headlines by preparing its own structured notes tied to the performance of spot Bitcoin ETFs like BlackRock's IBIT. These are complex derivative products that offer clients leveraged exposure to Bitcoin's price, often with features like partial principal protection and capped returns. The mainstream take on this is overwhelmingly positive. See, the bulls are shouting. Even Jamie Dimon has capitulated. Bitcoin has won. This is the ultimate stamp of approval. Anthony Scaramucci called the move huge for the industry. But I think this is a dangerously naive reading of the situation. You have to ask yourself, does a predator, after years of circling its prey, suddenly decide to become its best friend? Or does it just change its method of attack? To me, Wall Street's move isn't an act of surrender, it's an act of co option. It's a strategic pivot from trying to kill Bitcoin from the outside to controlling it from the inside. Think about what these structured products are. They aren't a simple way for people to buy and hold Bitcoin. They are instruments of financial engineering. They allow banks to mediate, regulate, and most importantly, profit from Bitcoin's volatility without actually contributing to its core value of self custody and decentralization. They are helping create a paper Bitcoin market, a layer of abstraction that sits on top of the real asset. Whoever controls that layer holds immense power. This feels like a Trojan horse. They're using the appeal of safe, bank approved exposure to bring Bitcoin into their world under their rules. By offering products with some downside protection, they subtly teach investors to rely on the bank for risk management, not on Bitcoin's own properties. They are working to transform Bitcoin from a sovereign monetary asset into just another tradable instrument in their massive portfolio, like oil futures or interest rate swaps. They are packaging its revolutionary potential into a derivative that the existing banking system can digest and control. This isn't just about one bank. It's a symbol of a broader war for the future of money. Central banks and the governments they serve see a truly independent, decentralized system as a threat to their monopoly on money. For years, they tried ridicule and regulation, but that didn't work. Bitcoin was too resilient. So now they've shifted to a far more sophisticated strategy: infiltration and assimilation. If you can't beat it, absorb it. Financialize it to the point where the paper market becomes more important than the physical one. Create so many layers of derivatives, notes, and futures that the price is no longer driven by sovereign individuals, but by the complex, leveraged, and opaque dealings of a few powerful institutions. They will turn it into a tool for themselves, all while stripping it of its revolutionary soul. The surge to $90,000 seen through this lens looks very different. It might not be a grassroots rally celebrating Bitcoin's victory. It could be a rally that's being allowed and even encouraged by the very institutions that once scorned it. They could be luring the public into their newly built casino, which is built on Bitcoin's foundation, but with their own rules and their own house edge. They create the illusion of a rising tide to attract the liquidity they need to build and dominate this new paper market. So when you see a headline about a major bank launching a new Bitcoin product, don't just think adoption, think capture. This may not be a victory lap for Bitcoin. It could be the opening shot in a new, more dangerous phase of the war for control, and the average retail investor is being welcomed onto the battlefield as cannon fodder. Exhibit B: the fragility under the surface, the market's hollow core. Now that we understand the strategic game being played, let's look under the hood at the market itself. The bulls see a market flooded with cash, but I see a liquidity mirage. On the surface, the water looks deep, but just beneath, There are hidden sandbars that could wreck anyone who isn't paying attention. This is what I call the market's hidden fragility. First, what is liquidity? Simply put, it's the ability to buy or sell something without causing a huge price swing. A liquid market is stable, and a liquid market is thin and volatile, where one large order can send the price soaring or crashing. The crypto market in late 2025 is suffering from a dangerous form of fragility. While global liquidity has been a tailwind for assets this year, the situation is delicate. Some analysts note that liquidity from major central banks is showing signs of tightening, creating a more fragile environment. We saw this fragility firsthand in the sharp correction in November when Bitcoin plunged over 30% from its peak above $126,000 down toward the low $80,000. That move was made worse by a cascade of liquidations, with reports of billions in leveraged positions being wiped out. That is not the sign of a healthy, stable market. It's the sign of a market built on too much leverage, where a small move can trigger a catastrophic chain reaction. But the most overlooked part of this story involves leveraged players. Throughout 2024, and early 2025, many companies and funds poured billions into the market, often using debt like convertible notes to supercharge their bets. They were hailed as the heroes of institutional adoption. But here's the catch. A leveraged bet can unravel fast. As the price corrected from its peak, the value of these crypto-heavy balance sheets fell hard. Suddenly, some of these players could be facing pressure from their lenders. And what happens when a leveraged player is under pressure? They are forced to sell. These entities, which were a huge source of buying on the way up, may now become a hidden source of selling pressure. And because the market is so fragile, even small sales can have a huge impact on the price, creating a toxic feedback loop. The price drops, forcing them to sell more, which pushes the price down even further. This is a structural headwind that the simple bull narrative ignores. This potential selling pressure is happening at the same time that the much celebrated ETF flows have shown weakness. November saw some of the largest single day and monthly outflows from spot Bitcoin ETFs on record, with some reports citing net outflows over $3.5 billion for the month. So, while the bulls chant, the institutions are coming, the data shows that some institutions have been contributing to the sell-off. This brings us back to $90,000. If the market is so fragile and there's a hidden wave of selling pressure, how can the price be going up? This is the essence of the trap I see. This bounce may not be driven by genuine sustainable demand. It could be driven by short-term speculation, short covering, and retail investors who are suffering from a severe case of FOMO, chasing the price higher based on a hollow narrative. The big players understand this fragility. They see the thin order books. They know it takes far less money to push the price up now than it did a year ago. They can engineer a rally, wipe out the short sellers, and create a powerful illusion of strength. This could allow them to sell their holdings at higher prices to the euphoric retail buyers right before the next wave of structural selling hits the market. This is the fragility in action, a market that looks strong on the surface but is brittle underneath, ripe for manipulation. The bounce to $90,000 might not be a recovery. It could be the creaking sound a branch makes right before it snaps. Exhibit C, the anatomy of a dead cat bounce. Now that we've laid out the strategic game and the market's fragility, let's tie it all together with our final exhibit, the price action itself. When you look at the Bitcoin chart not with hope, but with a cold, objective, historical eye, a pattern emerges that I find alarming. What we may be witnessing is the classic anatomy of a dead cat bounce. What is a dead cat bounce? The term is grim, but it fits. It's a temporary, short-lived recovery in the price of a falling asset. After a steep drop, the price will sharply bounce, fooling many into thinking the worst is over. However, this bounce isn't sustainable. It's a sucker's rally. The price soon rolls over and continues its fall, often to levels even lower than before. Let's trace the recent price action. Bitcoin hit a spectacular peak of around $126,000 in early October. From there, it suffered a brutal and rapid fall. In November, the price crashed by over 30%, bottoming out around $81,000 to $82,000. This was a period of intense fear. The market was bleeding. And then, just as everyone was giving up, we got the bounce. From the lows near $82,000, the price ripped higher, reclaiming $85,000, then $88,000, and now pushing past $90,000. The mood changed on a dime. Fear turned to greed. Despair turned to euphoria. The narrative shifted from, is the bull market over, to the dip was a gift, next stop $150,000. This exact sequence, a sharp drop followed by a powerful V shaped recovery that fools the majority, is the hallmark of a dead cat bounce. This pattern has repeated itself countless times in financial markets, and especially in Bitcoin's volatile history. Look back at previous cycle tops. The initial crash is almost always followed by a deceptive rally that tricks people into buying back in before the real long term bear market begins. Some analysts are pointing to on chain metrics like the MVRV ratio as a sign that the bottom is in. MVRV compares the current price to the average price at which all coins last moved. A lower MVRV suggests profitability has been reset, and bulls say this means the market is a great value. But this could be another misreading of the data. While a very low MVRV below 1 has historically signaled major bottoms, the current levels are more in line with a mid cycle reset. These resets are often characterized by exactly what we are seeing: sharp, violent bounces that shake everyone out before the next major leg down. The reset in profitability is what provides the fuel for this deceptive bounce, but it doesn't mean the overall downtrend is over. This bounce is feeding on the desperation of those who missed the run up and the fear of those who sold the bottom. It feels like a rally built on emotion, not fundamentals. It's a rally happening on lower volume than the initial drop, another classic sign of a weak rebound. It's a rally running directly into a wall of resistance, the very price zone from which it previously broke down. In fact, technical analysis has pointed to the $88,000 level as a potential dead cat bounce target for a while now. When you combine this classic technical pattern with our first two exhibits, the picture becomes clearer in my mind. The big players could be using the market's fragility to engineer a textbook dead cat bounce. They could be creating a bull trap of epic proportions. They foster the euphoria and FOMO so they have enough liquidity to unload their positions onto the dumb money before the hidden structural issues, like forced selling from leveraged players, reassert themselves and drag the market down to its true bottom. This doesn't feel like a recovery, it feels like a trap. And from where I'm sitting, it looks like it's working perfectly. We've looked at the evidence. We've questioned the motives of institutional players. We've exposed the fragile core of the market, and we've identified what looks like a classic dead cat bounce on the charts. Now, it's time to put it all together, deliver my honest take, and lay out a clear, actionable strategy. My honest take: the great wealth transfer. Let's synthesize what we've discussed. My thesis is that the rally to $90,000 is not a sign of a healthy, resurgent bull market. I believe it is a masterfully crafted illusion. Exhibit A suggested that institutions aren't here to be our friends. They're here for control. They are building a paper based financial system on top of Bitcoin to capture its value. Exhibit B revealed that the market's foundation is brittle, plagued by hidden leverage and a slowdown in true global liquidity, creating a perfect environment for manipulation. Exhibit C showed that the price action is mirroring historical bull traps. The sharp drop followed by a euphoric bounce is a classic pattern designed to lure investors in before the next leg down. Putting it all together, my honest take is this: I believe we are in the middle of a trap. This entire price move from the $82,000 lows up to $90,000 and beyond feels like an orchestrated maneuver. It looks like a liquidity gathering event designed for one purpose: to facilitate a massive transfer of wealth. It seems designed to allow the smart money, the institutions and leveraged players who are under pressure, to offload their positions onto the hopeful, euphoric retail investor who is buying the new paradigm story. Therefore, I am not buying this rally. I am not celebrating this move to $90,000. I view it with extreme suspicion. I believe that buying into this hype right now is one of the highest risk, lowest reward moves in the market. In my opinion, you're not buying a dip. You're providing the exit liquidity for those who bought much lower and now see the writing on the wall. This doesn't look like an opportunity. It looks like a trapdoor painted to look like a launch pad. An actionable strategy: key levels and warning signs. Having a thesis is useless without a practical strategy. This isn't about panic selling everything. It's about being a defensive player in what I see as a dangerous environment. It's about defining your risk and knowing the key signals that will either prove this thesis right or wrong. Here is what I am watching. The entire dead cat bounce idea hinges on a critical zone of support. Based on my analysis, this level sits between roughly $82,000 and $86,000. This was the area of the recent low and represents a key technical and on-chain level. Here is the if-then scenario. If Bitcoin loses the $82,000 support level on a weekly closing basis, that would be a powerful confirmation of my thesis. A break below this floor would signal that the sellers have regained control and that the recent bounce was indeed a trap. This could open the door to a much deeper correction with potential targets around $55,900 or in a severe washout, even as low as $44,700. A move to those levels would represent the true capitulation event needed to flush out the leverage and form a sustainable bottom. Conversely, what would prove me wrong? If Bitcoin can find real sustained support above the $95,000 to $100,000 zone and begin to build a base for a move higher, it would suggest this bounce has more strength than I anticipate. However, until that happens, I view any price action below that level as being inside the trap zone. Here are the warning signs to watch. ETF flows. Keep a close eye on the daily net flows for the spot Bitcoin ETFs. If we start seeing a consistent pattern of large outflows, especially on days when the price is rising, that's a major red flag that institutions are selling into the rally. Trading volume. Is this rally happening on high, convincing volume, or is the volume fading as the price rises? A rally on declining volume is a classic sign of weakness. Open interest and liquidations. Watch the derivatives market. A massive spike in open interest combined with a rising price means the rally is being fueled by more and more leverage, a ticking time bomb. My strategy is simple: patience. I am sitting on the sidelines watching these key levels. I am not deploying fresh capital into Bitcoin at these prices. The risk of being caught in this trap is just too high for me. Real sustainable opportunities are born from fear and capitulation, not euphoria and FOMO. This isn't the time to be a hero, it's the time to be a strategist. Things in crypto change in a heartbeat, and this situation is developing fast. The levels and data we've talked about today can change in an instant. If you want to stay updated with my real-time analysis as this story unfolds, make sure you subscribe to the channel and hit that notification bell. This isn't a market where you can afford to get your information a week late. We've covered a ton of ground today. We've stepped behind the curtain to look at the market mechanics that are normally hidden. We've put forth a thesis that this surge to $90,000 is not the simple, bullish story the mainstream media is selling. It's a symptom of a much larger conflict: the war for control over the future of money. It may be a calculated move in a high stakes game being played by the most powerful financial institutions in the world. They aren't here to help Bitcoin achieve its destiny of creating a decentralized, fair monetary system. They are here to capture it, to tame it, and to absorb it into the very system it was designed to replace. This $90,000 price tag, in my view, is the bait. They are using the siren song of easy riches to lure in the public so they can offload their risk and cement their control. My purpose with this video was not to tell you what to think, but to show you how to think about this market more critically, to look beyond the price and understand the game being played. The coming months will be volatile, but those who can stay objective, who can see the chessboard for what it is and understand the player's motivations, will be the ones who not only survive, but thrive. Don't be a pawn in their game. Stay vigilant, stay informed, and question everything. The real story is rarely the one they tell you out in the open.